understand the market flow before we dive into such high frequency trading, and we're battling some of the sharpest, the biggest computers. We're dealing with algorithms, all type of or landmines that we're facing when we're on these low time frames, or when we're actually, and that was my point, when we're actually entering and I call it timid trading. It's where you take a run, and as soon as you see the market pull back, you hurry up to take profit. You take a run, you see it pull back, you're taking profit. Well, what you're doing, you're only paying the broker. We got to stop paying the broker, and we're taking a risk. We're taking a risk every time we re-enter the market like that. A risk of news, a risk of Trump jumping on and saying something. So we want to get to the point to where we have key levels that we have identified, and we're letting our trades run, gaining us pips. And now, instead of trying to just take profit every pullback, we're actually adding in positions on these pullbacks. Now, before you know it, what you're doing is you're at the same time, you're managing risk of this thing shooting back up. So this first initial position we got off the wedge, it's in profit. We're up maybe 40, 50 pips. We get in again. Even if this goes against us, we're not technically in a drawdown, because this trade, the first trade, is paying for the second trade until we get to a certain point. So we want to be conscious of that. But now we're negating risk, and we're adding on potential profit to our trade. So in this type of scenario, and I'm trying to think of the exact word for it, we're increasing the probability of us growing the account. So in versus us just dropping on, I know a lot of people that be like, hey man, I don't like to use those small lot sizes because I don't see any increase in my account. Well, this is where you get the increase of your account, but you don't have the risk of putting, say, a standard lot, or a 0.1 or a 0.10, and the market lollygags, and it induces some more sellers. They pull it up to here, to a previous high, which if you had a smaller lot, you could have held that to make sure it broke and was still going into a bullish trend. So now we're so negative versus us having, say, a 0.2, 0.3 here. Bam, we hit it up with another 0.3. Bam, we hit it with another 0.3. Now we have our full size in the market. And look how nice the market treats us at this point. Everything's paid for. Wham, there go our last leg. And we get the true move. We get all that with the 0.10, or with the standard lot that we were trying to, we've been fighting, looking for the perfect entry, looking for the perfect strategy, when we can just segment out our risk throughout the trade. So I think I'll end there with some of the tools and things that I'm using, and I'll open up the floor for any questions. I mean, pretty much any subject. But those are some of the concepts, a little bit of price action that I'm using, and just looking outside of the chart. I think that'll help probably about 80% of traders if we stop being so zoomed in, looking for this crossover, looking for that indicator, looking for this system, and we just pay attention to what they do on a daily and a weekly basis. I will add in that this goes even in more detail and more defined, that I can start showing you guys what we call bankers open and close, which is going to be the cycles inside of the cycles. So we go, this is a macro scheme, and we're going to go start looking, and we'll dive into a micro scheme, which you guys can start pinpointing the particular retracements. You can kind of look at what time it is in the day, what session we're on, and we can see how, for example, New York and Japan sessions or banks are running a certain way, and we'll pick up with London that may reverse it. If London doesn't reverse it, we look for the reversal with New York. The market typically doesn't run in the same direction for more than 2 sessions. So after 2 sessions, we typically see some type